during the last time, people habitually talked about distressed real estate. And I never actually, as many deals as I actually did during the last downturn, never actually came across, with some minor exceptions, distressed real estate. The real estate is fine. It's
right.
the capital stack
it's just resetting of basis based on new underwriting conditions, right? It's hey, this is where the world was when this loan was originated. Here's where the world actually is today, and based on today's new reality, what is the capital stack supposed to look like today under the new normal? To answer the second part of your question, it's different compared to when we're referencing that. Obviously, we're using the most recent credit crisis in 2008, 2009. It's when we actually started as a firm in 2009 with our very first distressed deal, which was a senior loan that we bought from Regions Bank here in Miami Beach on a busted condo project that was about 65% complete. And where we're spending a lot of the time talking today and strategizing today, and it goes back to our thesis when we started our distressed debt fund in the end of 2018, is how is it different? And to answer the how, you really got to focus on the who, right? The who that we know of in 2008, 2009 that we were buying from was your household names, your Regions banks, HSBC, Lehman Brothers, obviously, with their demise, and other regional banks of the sort. And what happened post that credit crisis was some fundamental changes, primarily driven by regulation. So you had Dodd-Frank and Basel III, and basically it required those household name banks to act differently in terms of real estate lending. And they left this void in the lending marketplace on transitional loans, construction loans, land loans, or anything that wasn't kind of existing, stabilized, middle of the fairway type asset classes or geographies. That stayed with the banks, and it was always your cheapest cost of capital was to stay with the banks. But the void that they left was a big void, and that void was filled en masse with private equity, hedge funds, what we call tourist lenders on that second or third tier. And if you look at kind of the year over year, the market share of loans that were actually made, every year had growth in the non-traditional lender space. And we've been borrowers from those guys on construction projects. We've been investors with some of those guys. But that void was filled. Now, an interesting tidbit there is that of the $400 or $500 billion, post 2010, that's filled that void, 90% or more of that has been raised by guys that were not lenders in 2008. And that's really what we found fascinating in terms of identifying the who, because a rising tide floats all ships, and most of these guys have had a great run for the past 10 or 12 years because there's been liquidity in the market, values have risen, borrowers have always had the ability to kind of refinance or play musical chairs from one lender to the next. And we anticipated a catalyst occurring where the music would stop. Obviously, on a human level, no one wanted it to be a pandemic. And also from a thesis level, no one, ourselves included, anticipated that would be kind of broad-based, all asset classes, all people, and where everyone in the world is kind of focused on one issue at the same time. So that's how it's different this time around. It's the who, and our focus is really on buying up from those folks that aren't equipped to deal with the stress and the complexities of litigation and non-performing loans. But even more broad-based than that is how are those folks capitalized? Because what burned everyone in 2008, 2009 was the credit crisis, which was really the financial engineering that had taken place, and the banks were the ones holding that risk. Well, today, that same financial engineering has occurred, just that risk piece is held by different people, meaning CMBS came back, very, very strongly. That's going to be tested in the next couple of years. But the repo lines, the warehouse facilities, the CLOs, the packaging of that risk was still the same. It's just either done by different people at origination or held by different people at the investor level, whether it's bondholders, institutional investors, individual investors through the funds that they invested in. So it's a different navigation. It's a different minefield this time. And the one positive from that in terms of society is that the banks are in generally very healthy shape. So while there's a need to prop up liquidity in the market for the conservative loans or the AAA bond pieces, or to keep actual business flowing, that's great. I think the government's done a great job there. But for the bad actors that were just doing the same thing again that they were doing in 2007, 2008, where they're super highly levered, there's no empathy, nor should there be for those folks.